It's been a big news week for SoFi this week. Among other pieces of news, we had the chief financial officer of the company, Chris Lapointe, talking at a fireside conference where he answered some of the burning questions we've had as retail investors while putting some of the bearish arguments to rest. However, the stock is still down this week. Where is the disconnect? Let's talk about it. Okay, so let's start off with some of the other pieces of news and then we'll end off with the Chris Lapointe fireside. Now, one thing I want to say before I start is if you're new to these videos, I compile the main pieces of news for SoFi in the community that I've been seeing, and I make a video every Friday to just summarize the news week that we've just had. I've been doing this for the last several months now, so if you're interested in SoFi and you want to keep updated with the stock, I definitely recommend you subscribe to the channel for more information. Starting off, SoFi stock is slightly down this week, about 2% as of this recording, but it's had a pretty volatile couple of days. It rose about 10% from Monday to Wednesday and then just gave it all back. On Monday, I posted about a Fidelity study which found that younger demographics of women are taking finance more seriously. This is a study from October 2023, and it found that Gen Z women are leading the way with regards to investing in the market, the highest out of all other age demographic at 71%. Of those women who invested in the stock market, 51% said that when there's market volatility, they would just wait it out compared to 43% of men. This report continues with a few stressors facing women in the markets today and some major finance goals, along with some other interesting metrics around women investing in general. This is a regular report from Fidelity. The main reason why I'm talking about it is because back in June, SoFi released their Face of Finance PR campaign, which highlighted women as a core demographic that the company was targeting, stating in their press release that data showed that women control $10 trillion worth of assets, and it's projected to rise over the next 3 to 5 years. In addition, women's rate of return on investments has been found to be higher than their male counterparts, and that single women are more likely to own a home than single men. Of course, this entire campaign was centered around fighting bias, around education. I think this is really validating to see some of these metrics, knowing that SoFi is actively targeting this demographic for their product offerings. It's a very, very minor point, but I think the Fidelity study from October immediately associated in my mind the SoFi campaign from June, just reiterating that they're on top of it, essentially. On Tuesday, Tanner on the FinTech Frenzy show dropped some rumors from a SoFi insider that level 1 options could be delayed as far as 2025, with the company focusing on dropping their crypto offerings in 2023 and diverting much of their attention in 2024 to automated investing. Of course, no official news around this has been shared, and this is strictly on the word of insiders. On Wednesday, we got news around the CPI print, which came in better than expected. October CPI rose 3.2% over the last 12 months versus the expected 3.3%. Now, this is what the market wants to see, as inflation falling faster would mean that the Fed hikes are doing their job and that we're not going to get any more Fed hikes, which risk breaking the economy. And it even pushes the market into the direction that the Fed may start cutting rates sooner than we expect. Fed interest rate cuts are now seen starting in May based on trading in Fed funds futures. And we've talked about this on the past couple of SoFi weeklies. Previously, this was July, then June, and now May. So it seems as the market is expecting the Fed to even cut sooner. This also breaks down one of the main bear cases against SoFi currently, because higher inflation and higher interest rates pushes borrowers with low FICO scores to default and also puts pressure on high FICO score borrowers, essentially SoFi members, making a default a primary concern for lending institutions across the board. This is why financials underperform during a recession, because of the risk of default. And this was one of the main drivers that drove SoFi up 10% from Monday to Wednesday, is essentially a better CPI print. But of course, the stock gave back all those gains after the fireside. And before I jump into the fireside, I want to run through some other pieces of news that you may have missed. I tweeted that SoFi launched Enhanced Income ETF. I think this was Tuesday or Wednesday, just combining treasuries and options trading to pursue monthly income. We don't have to spend too much time on this. I mean, it's another week, another SoFi product launch. They feature more details on the specific page, but in essence, this is rooted around US treasuries and looks to capitalize on volatility using option spreads, providing users with high potential yield and potential monthly income depending on market conditions. I saw this post also on web traffic for SoFi from both TipRanks and SimilarWeb, which both show increases in October web traffic. Now, you guys already know how I feel about web traffic as an early indicator of member additions. I basically think that, it's an imperfect measure as it leaves way too many factors out of the equation, but the trend is encouraging to see it going up. On Wednesday, Kyle White posted about this analyst from Compass Point reiterating a sell rating on SoFi with a price target of $5. And, while we're on the analyst point, let's chat about our favorite analyst, David Cavarini at Wedbush, who has a $3 price target on SoFi. Vadim posted this on Thursday, and I want to talk about it for just a second. So basically on Wednesday, SoFi's chief financial officer, Chris Lapointe, broke down some of the biggest bear cases at the Stevens fireside. Now, we're going to talk about that in just a second, but funny enough, as the SoFi community later found out, after the conference, Wedbush analyst David Cavarini reiterated his $3 price target, and the screenshot above outlines his note, stating in his note that SoFi did not provide the level at which loans are capped on. But this came literally one day after Chris Lapointe addressed this very point. Either he didn't listen to the conference, or he simply ignored what the CFO was saying, or he just wanted to spread some more FUD. Essentially, in a nutshell, this is the problem with a lot of these bearish arguments, coming out of Wedbush. They just have some of the facts plain wrong, despite management clearing up the issues. In this case, 24 hours after management cleared up the issue, it was brought up again in a reiteration of the $3 price target. So, that's that. Some encouraging news, at least, is that institutions are continuing to add to their SoFi positions per the new filings this week. Vanguard increased their position. We saw BlackRock increase their position 7%, holding over 40 million shares. Goldman increased their position by 41%. Holding over 7 million shares. Two Sigma Investments increased their position. State Street, Morgan Stanley, a lot of these big players from an institutional perspective. Which, look, this is obviously great, because all I've been seeing on X from the retail community is more and more FUD powered by a lot of these bear cases. Meanwhile, behind the scenes, institutions are continuing to load up on SoFi despite all of these analyst downgrades, despite all of this noise that's going on from the retail community. That's encouraging, right? That's what you want to see. Okay, on to the fireside chat. After the market closed on Wednesday, we heard from SoFi's chief financial officer at the Stevens annual conference fireside chat. Tanner and I streamed this live to over 400 people in attendance, and we listened together as SoFi's chief financial officer, Chris Lapointe, addressed loan sales. And further to that, he gave clear and important context on much of the FUD that's currently surrounding SoFi today. I was also live tweeting the main insights from this event, and the full video, I'll recommend that you check out a recording of that live stream. I'll tag it below. But in the moment after that live stream, I thought that this was one of the best and clearest opportunities that management had to answer some of the more prominent bear cases. Chris Lapointe discussed SoFi's growing market share across products, highlighting they had 2 million direct deposit accounts, 60% of the student loan refinancing market share, 9.5% of the personal loan market share, and they're barely scratching the surface with home loans, meaning that they still have a ton of room to keep growing. Chris Lapointe also highlighted that the company has been a secular grower, gaining market share in nearly every single product they're offering today, meanwhile highlighting that the legacy players are losing market share. And I think this also speaks to the strong growth in deposits, right? Deposits are at 15.7 billion. Most of the top banks lost on deposits in Q3. And this is important because direct deposits is essentially going to be the foundation of providing stable, low-cost funding for lending. Lapointe highlighted that about 65% of SoFi loans today are funded through deposits. Over the next several quarters, they want to get this to 80 to 90% so that their vast majority of lending is funded through their deposits. He also touched on the ruthless focus on underwriting, where the company only approves around 25% of loans, and they're constantly tightening their credit underwriting process, only focusing on prime borrowers, super prime borrowers. Credit performance remains strong. This is also breaking down that bear case on the macro perspective of delinquencies to say that we're only targeting really, really high FICO borrowers. And he also mentioned that the majority of unsecured personal loans are just people that are refinancing or that are consolidating their credit card debt into lower monthly payments. So essentially being fiscally responsible. He also provided a clear and detailed breakdown of loan sales and the concerns that sparked from the 10Q, which was published last week. He talked about the ABS transaction that was announced on the earnings call with BlackRock, which closed last Friday at 105%. He shared more details on the $2 billion forward flow agreement. And on this note, he said that more details will come in the coming quarters, as the $2 billion is over the next 12 months. The structure, he said, is very consistent with the deal done in September. He talked about the fourth quarter, saying that guidance assumes personal loan originations are going to be down quarter over quarter, and that a significant portion of the growth in Q4 is going to come from the tech platform and the financial services segment. Currently, loans is the majority of their revenue, but Chris Lapointe highlighted that financial services and tech platform are going to drive over 50% of their revenue in 2024. This also coincides with the macro because as rates start to fall, personal loans are going to be negatively impacted, while student loans and home loans are going to be positively impacted, and the tech platform and the financial services platform are going to continue their ramp up. And this is a really interesting point, right? Looking forward, because SoFi is currently valued by the market with multiples consistent to that of a bank. On this point, with regards to the margins on their product lines, Lapointe highlighted that tech platform margins, which currently hover around 20 to 30% on average, longer term, the company expects those to be over 40% margins for the tech platform, right? So while many people are going to perceive this as a negative, they're going to say that, loans is their primary revenue source today, and that's going to fall going forward, therefore I should sell. I perceive it as a positive to argue that Q3 was really an inflection point for the company because it saw all three of their business segments being profitable, and going forward, it's going to see the acceleration in terms of financial services and in terms of their tech platform in general, as the business is going to accelerate not only from a margins perspective on both of those segments, but also as a percentage of the contribution to the revenue mix. It's not going to be so heavily dependent on lending. It's going to be more of an even split across their different segments. However, the stock fell as much as 10% after that session on Thursday, after these comments. So, why is it down? Well, a good portion of it was with regards to the macro fears. Fintechs across the board fell on Thursday. Chris Patel here in this tweet provides a reason, which is predominantly macro-driven, basically reiterating that a weaker consumer will lead to rising delinquencies, which will have a negative impact to SoFi's earnings going forward. This has been the prevailing macro bear case all year long in anticipation of a widespread recession, which leads to higher delinquencies. Chris also posted this chart around the market cycle in general, stating that if you believe that we are headed towards a recession, financials will typically underperform the market during such periods from a historical perspective. However, one thing I found on this is that currently, bank and retail issued credit card delinquency rates are still far below the last two major crashes in 2008 and in 2000, going back in this table as far as 1999. Here in this table, you can see the color coding on the right around the 90-day plus delinquencies, but you can also see charge-off rates, 30 to 60-day delinquencies and 60 to 90-day delinquencies respectively, all being lower in 2023 than in previous crashes. Now, of course, the bearish argument is to say that the recession hasn't really started yet. It's still ahead of us in 2024, and that these numbers that we're seeing on the chart right now are going to get much, much worse. However, when it comes to the macro bear case, this is one thing that we've been highlighting consistently throughout the year and have been monitoring very closely. It should really come as no surprise. I think that is should be mostly priced in. Overall, from a company perspective, I think this week was really great because we don't get a lot of opportunities where management can break down and disassemble these bear cases like they did on Wednesday, even reiterating very clearly the gap profitability, which is around the corner in Q4. In the short term, the stock is going to be volatile, the stock is going to react. But I think if we zoom out and we actually look at the company trajectory and what's coming up in future quarters, the company is doing really great, even taking the macro into consideration, right? I added to my SoFi position earlier today, just as I did last week and the week before that. And I'm going to keep adding to my SoFi position, I think, because I fundamentally believe in the execution that this company has and in their ability to pivot regardless of whatever the macro circumstances might be. And of course, in anticipation of that Q4 profitability and a healthier mix with regards to their margins and their revenue contribution to essentially equally distribute how they make more money so that it's not so heavily dependent on lending. For right now, this is the Fundamentals of Investing podcast. Thank you so much for listening.